Liabilities, what do we owe? Obligation to others. We obviously wanted to begin with a definition of what a liability is. You're going to have to give up some assets. Assets can generally be in the form of cash, but it could be any asset actually. But it has to deal with a past event. So we are going to give up a future asset because of something that happened in the past. We have an obligation to provide something to someone. Generally, it's going to be cash. Liabilities can be short-term. Liabilities can be long-term. So when an organization like Starbucks or Target, they have gift cards. Well, those gift cards are purchased with cash, actually. And by purchasing those assets in cash, you generally are provided a credit to purchase whatever that dollar amount will allow you to buy. So the organization that issues those gift cards have an obligation. They're going to be a long-term obligation, but generally they're short-term, and the gift holder is going to have to, utilize that gift card, and until they do, the organization is obligated to honor it. So when an organization has I would call it a warranty of such kinds. If they have a warranty and they say, well, within 2 years, if certain things happen to this device that we sold you, we will repair it or we will replace it. And again, you have to make certain that you have on your books that warranty obligation. And valuing that is a whole process altogether. But the most important thing is, how do we deal with warranties? How do we deal with them on our financial statements? How do we account for them? And in addition to that, how do we disclose them to others who read our financial statements? And everybody has purchased an item or two that you've been given an opportunity to purchase a warranty. A warranty is just saying a little piece of insurance. I may very well need to get this repaired, or within a certain period of time, if something goes wrong, you can be confident that we will either fix it or replace it. So on the books of the warrantor or the organization that provides the warranty, they have to disclose they have a possible future obligation to provide services to repair the products that they've sold or to replace. And as accountants, we need to be able to determine the appropriate valuation of those warranties and how we record them on our books. And this is just an example of how to record. I don't want to spend too much time on how to record, how to calculate. I do want to talk about the conceptual side of things. What's happening when we have warranties, and why is it so important that we show to others looking at our financial statements that these warranties exist, and at some point we have to honor it. And this is what the obligation is. Warranties generally are 1 to 2 years. Some are 5. So they come in a short-term obligation and turn into a long-term obligation. But in the end of it all, we have to show that there is a possibility that something could happen to the products that we've sold. And we have to ensure that those individual customers are provided with either repairs or some type of replacement strategy for those particular products. So we record the sale, we record the revenue, and we record the cash that we receive, but we also have to consider that there's something could go wrong. And warranty revenue can be pretty significant when you're talking about purchasing a motor vehicle, and that motor vehicle gives you an extended warranty that's beyond 25,000 or 50,000 miles. That's pretty expensive. It's like around $18 to $2,000. And then assume that you sold 15 cars. That could be a tremendous amount of money. So warranty revenues have to be matched with a corresponding obligation to provide a service to that particular customer or customers if something were to go wrong. So it becomes an important figure on your financial statements. And again, warranties are just one of many type of obligations, short-term and long-term, that an organization have to provide to others, third parties. Loans are another obligation. Again, could be long-term or short-term, but loans in terms of a bond is a debenture. It is actually a coupon where you have an obligation, a contractual obligation to pay back this bond. And bonds are generally provided to organizations as a mechanism for raising money. They can, you could raise money using capital, which is your equity, and by selling common stock or preferred stock, or you can raise money through debt. And debt could be in a bond, debt could be in some type of other type of a note payable or an installment loan or a line of credit. All in all, these loans have to be paid back. You have to pay it back. So what you'll need to learn is how to record those long-term obligations. And of those obligations, if there's a current portion to that, you have to make certain that the current portion is separate on your financial statements. The current portion would be the amount that's due within a year, and then the long-term portion would be the amount that's due longer than a year. The most important thing is what is a long-term liability. A note payable is one, a bond payable is another, a mortgage payable is another. These are just examples of typical long-term liabilities from borrowing. So issuing and selling of bonds, and again, in this particular course, we're not going to be digging so deep into the bonds, but it is important to understand what a bond is and how it's recorded on your books. So I'm not going to read the slide, but what I'm going to do is talk about it. Let's give you an example. There is an organization called TLM, and they are looking to purchase another company. To do that, they will need a tremendous amount of cash. They don't have that kind of cash. And in fact, they're going to look to raising cash through a bond issuance. How they do that? Well, if they want to purchase a business and it costs $5 million, but they only have $1 million in the bank, so they can't possibly pay it outright with cash. And also, it's not always the best idea to completely deplete your cash reserve. So for that organization, they have a choice. They can either go through an equity to finance this transaction, or they can do a debt. And if they do a debt, what would be the best way that they could get the most money for, I would say, the least amount of cost, in this case, interest expense. So corporate bonds or other type of bonds are a good way to raise money, a lot of money, in fact, millions upon millions of dollars, when you're not willing or able to sell equity. So a bond is an indenture. It is a contract. It is a contract between you and the individual who buys your bond. And that bond basically is saying that in 20 years, 10 years, 5 years, you are going to pay back the amount of that bond. Bonds are generally sold around $1,000 each, generally, not always, sometimes they're more. There are different types of bonds: municipal bonds, corporate bonds, munis, just many different types, but they all have this single factor in common. They are a means by which an organization seeks to raise a tremendous amount of money. They also have the characteristics of paying interest being paid generally twice a year. So 2 times out of the year, every 6 months, a payment of interest is made. They also have the obligation to pay it back at the end of the term. Some bonds do mature over time. They're called serial bonds, and they have many different dates of the principal would be due. So an organization will will actually go out and sell a bond, and they sell it for, let's say, $1 million. Let's say I want $1 million bond. But if that organization is risky, and there are other bonds of similar type in the marketplace are paying a higher rate of interest than your bond is paying, you're not going to get $1 million. You're going to get less. So if you're paying less than the market, you're going to be selling it at a discount. But if your bond is paying 9% and the market rate is at 8%, you're going to get that bond at a premium. You're going to get more than the face amount. So the face amount of the bond, or the $1 million, is called the coupon face. It's going to be the face amount. That's going to be the contract amount that is going to be paid back at the end of the term. If you are going to receive that amount at the time of issuance, you have purchased or you have sold the bond at face value. The face value is the contract amount, and that's going to be on the face of the bond. Then, if you are going to buy, if you're going to sell bonds and you're going to sell them at an amount that is less than the face amount, you are getting the bond at a discount. And we'll talk about how the discount is amortized over the life of the bond. But let's just understand a bond sold at its face, a bond sold above its face is at the premium. A bond that's sold at an amount lower than its face is called a discount. And knowing that is kind of important because everything we're going to be talking about is going to talk about, is it at a face value? Is it at par? Is it above par? That means it's a premium. Is it below par? That's a discount. And why that happens. And how can you tell if you're given some instruction, how can you tell if a bond is sold at a premium or a discount if if it doesn't tell you? The interest rate is going to be the key. Now, an interest rate obviously is going to be the rate that they have to pay back for using this money. This is the cost of the borrowing. So if the rate of interest, the coupon rate is 9%, and you check the market rate, if the market rate is higher than that, then you know that you're not going to get the face amount of the bond because the market is paying more than what you're willing to pay. And if the market's paying more than you're willing to pay, they're going to not pay as much. I'm not going to give you all that you're asking for. I'm going to give you somewhat less because you're not paying me in interest what the market is paying. So that means you're going to get a discount. But if the coupon rate is higher than the market, that means you're paying more than what the market is paying. And people are willing to buy your bonds, and then you will get more than the par value or the coupon amount of that bond. So if you look at bond transactions that are given to you and you don't know, and how do you figure out without doing a whole lot of computations whether or not it's sold at par or at a premium or a discount, look at the differences in the interest rate. If the interest rates are the same, you purchased it or you sold it at par. If the interest rates are different, then you say, okay, it's sold over or under par. How do I know which? If the market rate of interest is higher, it's going to be sold at a discount. If the market rate of interest is lower than what you're willing to pay, or more than what you're paying or you're offering to pay, it's going to be at a premium. So you're paying, if your rate of interest that you're going to be paying the individuals who buy your bond is higher than the market, they're going to want your bond. They're going to want your bond and going to pay more to get it. But if you're going to offer them less interest in the market, they're not going to want to pay that much for it because they want to get a return for the investment in your bond. So they're going to pay less than the face amount of the bond. So the effective interest rate, again, when we're talking about amortizing bonds and bond premiums and bond discounts, we have the effective interest method and we have the straight line method, and both have their own set of rules. I would certainly want you to take a look at what's in your chapter and go through how the effective interest method is used. And I'm going to talk about it in this section, but you're really going to need to look at your examples because the examples are very, very helpful. Let's assume that you have a bond that you have issued. You sold a bond, and I'm going to put on my piece of paper here, I have a $100,000 bond. And that $100,000 bond, let's take a look at that. Okay, just one second. I'm going to have to write this down. Okay, let's look at one example. Water sports company patented and successfully marketed its new product. To expand and produce this product, he needs to raise $800,000 in financing. So at the beginning of the year 2013, they obtained money in two ways. They signed a $400,000 10% installment note to be paid in 5 equal installments to be made on December 31st, 2013 through 2017. Then they issued a 5-year bond with a par value of $400,000. The bonds will have a 12% annual contract rate and pay interest on the 30th and the December the 31st. The market rate is 10%. We're not going to work on part A. I want to work on part B. The first thing I want to ask you is this bond sale at a discount or premium? That's the first question. How do we know that? It's not really telling us much. So the first thing we need to consider is $400,000 is going to be the value that they pay back. That's very, very important. Why? Because it says the par value. That's what they're going to pay back. And we also know that 12% is the contract rate. That's going to be the interest by which they pay. They pay every 6 months. They're going to pay, actually going to pay 12% annually. So it's going to be 6% every 6 months. But also, they pay it 2 times out of the year, June and December. Very, very important information when you're trying to calculate this. That being said, then the question then becomes, is it a bond discount or a bond premium? And remember, we had talked about this. If the company is willing to pay more than market in interest than the market, investors are willing to buy it, the bond, at a higher price. Therefore, the answer is it's going to be sold. The bond will be sold at a premium. However, if the bond rate of interest is lower than the market, people can get a higher return with other bonds. Therefore, they are less willing to pay face or par value, in which case the bond will sell at a discount. That's the first thing. And think about this for a second, and then we're going to proceed a little further to go into the details of how to calculate all of this. Now that we know that this particular example, bond will be sold at a premium. Very important. Why? Because the amount of interest that's going to be paid to the bondholders is higher than the market. So, that being said, how much? How much was the prime proceeds? And then the next question is, what is the entry to record the bond sale? Okay. How much was the bond proceeds? This is how much money did the organization, in this case WSC, receive at the time the bonds were issued. Well, in doing so, you have to first calculate the present value. What is the present value of this bond? And in doing so, we're taking the bond and we're splitting it into 2 pieces. One piece is going to be the interest component, present value, which is this number here. And the other is going to be based on this value here. We want to know the present value of a future $400,000 bond. So we're going to use a table to do that. So in order to determine how much money was received, we want the present value of the interest payments that will be made, which is right here, present value of interest payments. And we want to know the present value of the bond at par value. Therefore, if we take the 2 and we add the 245,560, oops, let me try this again. So if we take the 245,000. Let's try this again. 245, 560, and add the 185, 320. You come up with a total of, give me a minute, sure I did that right, 185,320 plus the 245, 560. It gets me 430,880. And if you can see, this 430,000 is higher than the par value of the bond. Par value is 400,000. The proceeds is 430,880, which gives you a premium of $30,880. Now let's record this entry. We received cash, debit of 430,880. We have and I'm going to try to make sure we stay on the same page here. We have a bond payable of 400,000. And then finally, we have a credit, a premium payable of 30,880. Very good. So when you're looking at a problem such as this, and they ask you, can you determine if this was sold at a bond discount or a bond premium? You can tell without doing any calculations by comparing the market rate of interest and the coupon rate of interest. And remember, if a company is going to be willing to pay more interest than the market, if the company is willing to pay more interest in the market, investors are going to be willing to buy it at a higher price, and that's going to be sold at a premium. If the bond rate is going to be lower than the market, people can get a higher return from other bonds. They're not likely to pay the face value of their bond, and it's more likely going to be paid at a discount. And here is the numbers and how we've calculated the fact that yes, even we were looking at it and we said, okay, yes, the rates of interest are different, and the rate that the organization is willing to pay is higher than the market, and it proved in calculation that the bond was paid at a premium, because as you can see, the proceeds, the money that the company received at the time of the sale, was more or higher than the par value or the coupon rate of that bond. So this chapter is very, very informative, and it's important for you to see that it's an easy way to calculate these. Now, don't lose heart about this. All we're doing is calculating present value. We want to know the present value of the interest payments that are being made and the present value of the 400,000. And we utilize the tables to do that. When we think about installment loans, the only thing that I think is a little unique with this is when we're dealing with installment loans, you'll see one payment, $50,000, $10,000, or $100,000. And you'll see monthly, that monthly payment, in this case, $600, we have to calculate the portion of that payment that applies to both the interest and the principal. And that's what an installment loan example is showing you. All it's showing you here in this case is how can we take that payment? How can we determine from the payment amount and the rate of interest for that particular loan, what part of it is the expense and what part of it is the principal? And utilizing that information to not only record our transaction or the payment, but also create an amortization schedule. Installment loans are a little bit more straightforward because the only thing that's different is we're taking a series of payments, which is installment payments, and determining how to calculate the interest portion of that installment payment. We want to make certain that the interest is removed so that we can record the expense and we can remove and reduce our obligation or our liability. And that's going to be important in that case. Also, leases. Leases are another very, very complex area, but I would say in this course, understanding leases is just knowing the difference between the two types of leases, an operating lease and a finance lease. Operating lease is going to be 1 year, maybe longer, and it's definitely going to be like a rent. You pay a rent every single month. It's going to be operating lease. But if it's a finance lease, look at the criteria that we see here on the screen and also reading your book. Knowing the difference between an operating lease and a finance lease is going to be important, because it's going to show you what's part of the transaction is going to hit the balance sheet, if anything, or what's going to affect the income statement. How it's seen, how it's recorded, and amortization if necessary, or depreciation in this case is necessary. So if it's a finance lease, it's going to be a transfer of ownership, it's going to be a bargain purchase, it's going to have a useful life, and it's going to most certainly have a fair value. When you meet those basic criteria, you're going to know that you're dealing with a finance lease, in which case it's going to be an asset recorded on your books, to which you will have to apply an amortization or depreciation to that asset over the life of that lease. And as I mentioned before, thank you very much for your time, and I'm hoping this chapter is not overwhelming for you. By all means, ask any questions you might have, and I will talk to you in my next video.